Eric, we will be speaking about your 17th annual hedge fund survey, where you were researching and presenting what I call consistent performers. So tell me in your words, Eric, what makes for a consistent performing manager?
Hi, Matthias. Thanks for having me and giving me the opportunity to discuss consistent performers in the hedge fund industry. My work is based on my latest hedge fund review, which is my 17th annual survey. Previous editions were prepared for the Financial Times, for Barron's, the Wall Street Journal, and this year's edition was commissioned by SALT. And the work that goes into helping determine consistent performance is pretty basic. There's nothing magical about it. It's getting a hold of a lot of databases, crunching a lot of numbers, tapping into personal resources and other people's connections to hedge fund industry to hope to put together the most compelling universe of funds possible, and then screening them for consistency. And that's generally what I do in order to first generate a list of funds that I think are worth investors' time to begin their search for a particular allocation. The qualities that I think make up the most consistent performers are those who have specific strategies and investment processes that they stick close to. And that's a real key, because inconsistency is not just a product of market volatility, but it's also a product of when you deviate from a process. And I think that's the most important quality that you should look for in a hedge fund manager. It's not just a matter of being in the right place at the right time, because there's going to be all sorts of kinks and unusual behaviors in markets year in, year out, cycle in and cycle out. That's to be expected. And the good hedge funds, the most consistent hedge fund managers, know how to navigate these difficult challenges in the markets. And to me, when the market is down, it's not that the hedge fund manager has to be up, because I think that's a hard expectation, especially when the market takes a deep dive. I think it's controlling loss, controlling volatility, and being ahead in absolute terms from where the market is. And in that way, that means over the longer period of time, their average annual performance will be more consistent than most other hedge funds. Because in the large scheme of things, I think the vast majority of hedge funds really aren't worth most investors' time. And it's being able to sift through all of the noise in order to find those funds that I think are most compelling. And that's exactly what the purpose of this survey is.
I don't see anymore these type of high quality in-depth surveys on hedge funds being produced by financial media. Why is that?
In terms of other surveys being done in that track hedge funds, there are not many at all, if any. It wasn't that long ago that Bloomberg, Institutional Investor, Barron's, among other publications, would run an annual review. They're just not happening anymore, and that's largely due to two things. One, I think much of the sentiment towards hedge funds are negative. And then it begs the question, why commit resources to an asset class that people aren't thrilled about? And I think it's a very arbitrary decision, because that's just looking at the surface. And as I said before, there's a lot of hedge funds out there that are not worth our time. But there are a number of good hedge funds which are. And the media is just not making the effort anymore to do that kind of research. And the second reason they're not willing to do it is finances. They just don't want to commit the time, energy, resources on a story that takes several months to develop, where right now the MO for most media outlets is getting out a quick story as promptly as possible and in the most timely manner as possible. And this is why they don't want to produce hedge fund surveys anymore. And it's another reason why I opted to work with SALT this year, because I felt it got me much more closely linked to the right kind of viewership than the other media outlets that I had been working for, despite how significant those publications were.
I mentioned that this is already the 17th annual hedge fund study. Tell us, Eric, how did you get started with this, and why are you continuing these studies? And lastly, why do you think they are important?
The survey that I prepared for SALT is unique. All previous hedge fund surveys that I've ever seen are very rudimentary. They might look at assets, they might look at short-term performance, perhaps 1 year, at most what I did for Barron's 3 years. I did do a survey for the Financial Times that went out 5 years, but that was really an outlier. None of the major publishers ever really dug deeply into hedge funds to really help explain the nature of the performance, not just their numbers, not just the size of assets, not just the wealth of managers, but in fact that give you more color, not just of how they made money, but the volatility, the drawdown, the correlation to the S&P 500, all the different bits and pieces that help give you a bit more information to better understand the nature of performance. So my survey includes 20 different metrics that you'll find, and that's unheard of. None of the surveys I've ever been associated with or those that I've seen, which I haven't been, would ever dare do that. And I think this is what makes this survey unique. And I think it also helps affirm what consistent performers look like and what inconsistent performers look like. And the metrics I follow are not just returns. I do it 1, 3, 5 years, as well as since inception. And the history of some of these funds go back 20 years. So being able to see performance not over the short term, not over the medium term, but also since inception really helps drive home the point of how consistent a fund manager is. I also look at volatility, standard deviation, over the same periods. And it's very important to correlate returns and volatility. Same thing for drawdowns, because those drawdowns can occur and can be masked by strong performance that follows. But to be able to see if a fund drops 20, 30% on the way to making a 15 or 20% annualized return is really important if you really want to understand the nuance of management. And also, as I mentioned earlier, the correlation to the S&P 500 is also important. It's not that the funds are likely to be closet indexers. There's just too many different strategies for that to happen. But what the correlation data point tells you is how differentiated that return stream is from the market. Because at the end of the day, that's one of the key reasons why people should invest in hedge funds. It's to find a different way to generate returns that hopefully is somewhat and to some significant degree distinct from the marketplace. Now, you can't disconnect altogether from the market because it does show investor sentiment, and that investor sentiment is going to be affecting all investments. But to be able to see that a fund, a manager, can actually generate decent returns that are uncorrelated to market and yet are comparable to market returns, then you have an additional type of investment that I think that can enhance any portfolio.
What do you think, Eric? Do the mainstream media and also the somewhat more sophisticated media get wrong about hedge funds? And also, does this distorted perception somehow also negatively affect investors?
When I got started with hedge fund surveys, it was with Barron's, and it was right before the Great Recession struck. And I think 2007 was the first year I was tracking. And I knew next to nothing about hedge funds. And the first thing that threw me off about hedge funds is the name itself, because that's misleading. A hedge fund actually may hedge or it may not hedge. And there's so many different types of strategies that hedge fund managers pursue. And the media has gotten this so wrong that anybody who's relying on mainstream publications and even somewhat sophisticated publications are going to miss the larger point. And that is, the hedge fund industry isn't some monolithic entity. So when you read that hedge funds are down, that tells the story. It doesn't. You have to distinguish by strategy. And there's at least 15 distinct major strategies out there that are worth pursuing and looking at in order to understand the range of opportunities that hedge funds offer. The key takeaway that any viewer of this program and anyone who looks at my survey is to understand that hedge funds first and foremost are asset managers. And again, going back to media perception, that's where I think the media gets it wrong, because I think a lot of the writers, they end up being young and they probably are influenced by the old perception that hedge fund managers are swashbuckling kind of investors who are willing to take great risk. And that perception does not characterize the bulk of the industry anymore. And that's largely due to the institutionalization of the industry. Because after institutions saw how well hedge funds held up during the tech wreck in 2000, how well they actually survived the Great Recession, which is one thing the media got completely wrong, where hedge funds were condemned. The market was down 37%, and the average long equity long short fund was down 12%. And going back to my thesis, I don't think a fund has to be positive when the market is down 37% to prove its worth and to show that it's a consistent performer. And the media has just distorted that reality. But where the media has gotten it right is that a lot of hedge funds just certainly shouldn't be around, and investors probably shouldn't be considering most of them. And that I would agree with. So the bottom line in terms of what this survey tries to do is isolate all the noise, all of the kinds of funds that I think managers shouldn't be in, because at the end of the day, no one needs to be in a hedge fund. You have to find the right fit, the right manager, the right strategy, the right processes, etc., before you decide to make a commitment into a hedge fund.